Good afternoon. Thank you for joining us for this webinar. We're going to talk about GIB residency and about expat mortgages. Firstly, let me say thank you for accepting our invitation to our webinar, Simon. I look forward to hearing everything you have to say about expat mortgages. You've been in this field for many, many years, first with Leeds Building Society before you set up on your own. And perhaps, Simon, you can make a quick intro to the audience as to who you are and what you do.
Yeah, sure. Thanks, Paul, for having me along. So my name's Simon Murphy. I'm the owner and founder of mymortgagedeal.co.uk. So I've got about 2 decades of financial services experience, as you mentioned, working for some high street banks and financial institutions in the UK before moving to Spain in 2008. So I've been here, coming up 13 years, I suppose. I've sort of been involved with expat financial services since then. And more recently, my focus has been predominantly around expat mortgages, helping expats or foreign nationals to buy, refinance, or release equity on their UK property. I've also been involved in helping expats and foreign nationals with Euro mortgages, so looking at Spain, Portugal, and France. So that's a little bit about me. What about you, Paul? Do you want to introduce yourself?
Yeah, absolutely. We're a boutique wealth management practice dedicated to helping British expats and English-speaking expats with their tax planning, financial planning, retirement planning, and more broadly, their wealth management needs. Clearly, our service offering is more extensive than that. We have other service lines, including relocation advice to Gibraltar, but equally we do succession and estate planning. We offer insurance solutions, family office, risk management, and so forth. And our clients are I like keeping things simple. We have 3 segments. We service the retirees, global entrepreneurs, and then internationally mobile senior executives. And we serve 3 markets predominantly. One is Europe, mainly the Iberian Peninsula. Secondly, the UK, because a lot of our expats eventually go back to their home country once they are well past retirement. And then thirdly, we have a segment of clients in Africa, West Africa to be more precise, and they're mainly executives in Africa.
Yeah, very good. I mean, it's the same with me that our clients can come from all over, really. So I think the audience can understand why we've linked together, because there's so many crossovers, isn't there?
Absolutely.
But as we've just had, and we were just talking before we began, we've just had the UK budget, haven't we? So finance and particularly tax is on the minds of many people today. But a question for you, Paul, is have you experienced a surge in demand for Gibraltar residency applications post-Brexit?
Yeah, just quickly before I answer your question, we're a bit of a quirky firm in that we have legal roots because, we are majority owned by a law firm, the oldest law practice in Gibraltar. But equally, we've got accountancy roots because we belong to a top 20 global accountancy network called MGI Worldwide, which employs, 10,000 professionals in 300 countries across 7 continents, driving close to $1 billion in revenue. So we've got that additional ability to be able to provide advice, drawing on the expertise of associated firms. So sorry, I'll go back to your question. And if I may just say, we were going to play a video explaining who we are and what we do, but we had some issues with sound. So Alice, who's moderating this webinar, will be sending you a link to that video so you can play it at your leisure with sound, and you'll appreciate it much more that way. So apologies for a bit of a glitch with this webinar, but it does happen from time to time. Simon, in answer to your question, yes, we have seen a massive increase in the number of inquiries mainly from Brits living in Spain, but equally from those residing in the UK. I think that the interest that we've had lately from Brits in Spain is a post-Brexit phenomenon. I mean, we all know, and we talk about, Brits having lived under the radar in Spain for many decades. I was going to say years, but I think decades is probably more precise, who are no longer UK residents, but they're not residents anywhere. They're effectively tax nomads. So clearly, with the tightening of the rules and, double taxation agreement between Gibraltar and Spain and so forth, I think people are at the back of their minds. They know that they need to do something. We've got common reporting standards, which involves automatic exchange of financial information, a new EU directive, which has just kicked in called DAC 6, which seeks to address aggressive tax planning. So there's nowhere to hide anymore. So the game is up, and people realize they have to rearrange the tax affairs to make them more tax efficient. And this has been, I think, Brexit has been the wake-up call. So yes, we have witnessed a big surge in demand for Brits looking to relocate to Gibraltar for the reasons I've outlined, from Spain, but from the UK too. And from the UK, it comes for three reasons. One, we find British retirees looking for a better quality of life in their sunset years, and Gibraltar is more in the news, and they see, well, we can have a British standard of living, but out in the Med with all the benefits that brings. So we are seeing interest from UK retirees. We're also seeing interest from those seeking a combination of lifestyle benefits and greater tax efficiency. So that has been another factor which is driving the numbers of inquiries coming through. And then thirdly, I think what we're seeing is entrepreneurs who are looking to redomicile their business to optimize their tax position and grow their wealth. And they tend to be younger in age, but they have the same goals in mind, and they're more mobile because of age and a young family and so on. And they see Gibraltar as a tech hub and one that is growing, and then that could offer, both the tax benefits, the ability to be entrepreneurial and so on, but equally the quality of life for young families. So all those things are driving inquiries recently, and more than ever before. We've been doing residency for a long time. So Simon, sorry. No.
Yeah. Well, you've answered that very well. I think I would concur with you on many of those points. The reasons for Gibraltar being an attractive region, and of course, people can live on the coast and easily commute to Gibraltar as well. But one question that perhaps people may be wondering is, how does someone obtain residency in Gibraltar?
Well, there's various routes to residency, and it always depends on whether the applicant is in receipt of passive income or earned income. That is really the deciding factor. I would say one size doesn't fit all. No two cases are ever alike. And it's the client's unique set of circumstances which determines the type of residency application that we submit to the authorities. So it's a question of digging deep, understanding, the whole case, and then determining the best way forward. The residency conditions, if I may add, will vary markedly depending on the route we take. With self-sufficiency status, which is applicable to individuals with passive income, the route is less onerous than category 2 or high net worth individual status. And the advantages are zero tax on passive income, on interest payments, on dividends from recognized stock exchanges, zero tax on capital gains, 2.5% tax on pension income from a Gibraltar-based QRUPS or QNUPS arrangement, and potentially, and I say this, it depends on the case, but potentially you could end up paying no tax whatsoever in GIB, so long as you can show and demonstrate that you're not a burden on the state and that you have sufficient means to be able to sustain yourself and your family. So that's one route, the least onerous route. And then you have Cat 2, where the conditions are more stringent, and you require to have a minimum net worth of 2 million. You need to own or rent an approved accommodation, not just any accommodation. It has to be a property which has been tagged as Cat 2 status approved. And it has to be of a sufficient size for the exclusive use of the applicant and the immediate family. You require private medical insurance for self and family. That might vary for self-sufficiency. It might be different for a Brit of retirement age. Then after you've submitted the application, what you tend to find is that you can cancel your private medical and rely on the state. There's other conditions attached. You can't have been a resident in Gibraltar for the 5 previous tax years. You cannot engage in a trade or business or employment which competes with a locally established business. Of course, there's some caveats to that, and you can apply to the Ministry of Finance for a ruling on what constitutes a competing business and what is an allowable enterprise that you can carry out from Gibraltar. Taxes on worldwide income is minimal of 22,000, capped up 27,560. Extremely interesting, but each route has its benefits, but it has its drawbacks too. And for Katsu, you have to be earning well in excess of 120,000 to even consider this option. But it is very interesting.
The good thing, I suppose, is that you've got those legal and accounting routes in your business, so you can give best advice on the route to take for individuals.
No, well, the advice we give it in-house. It's only when it becomes complicated, there could be immigration issues and so on, that we have to bring lawyers on board. Or if there's a cross-border issue, which is not UK GIB, could be, a third country where we don't purport to have any expertise, then of course we can tap into the MGI global network and find someone in the home country of where the individual currently resides to make sure that the advice from that side, which is just as important when you exit one country as when you arrive in another, that the advice exiting your home country is as good as the advice we give when you arrive. And, we can carry out, advice, Spain, Gibraltar, Portugal, Gibraltar, UK, Gibraltar, but then, other jurisdictions, no. You need to bring someone on board that has the right skill set and expertise to give, top-end advice, yeah?
Yeah.
And make sure that it's advice that holds.
Yeah.
Simon, a quick question for you. Can expats qualify for mortgages in the UK or other regions such as Spain, France, and Portugal? And if so, what are the things that one should consider when when an expatriate is looking to take up a mortgage in somewhere outside the UK?
Yeah, it's a good question. So this is an area that I've sort of specialized in the last number of years. So when we speak about expats, we mainly are speaking about British passport holders that are living in various locations around the world. They might be in Gibraltar itself, or they may be in parts of Europe. Spain, Portugal, France are key areas. But of course, there's other areas such as the Middle East. You've got Qatar, Dubai, Oman, Kuwait, Bahrain. You've got places like Hong Kong, Singapore, large British expat areas. So the quick answer is yes, they can either buy, refinance, or release capital on existing UK property back in the UK. But there's also another angle, which is the foreign national. So that might be someone who is an EU passport holder, or indeed in the case of Hong Kong, they might be a BNO passport holder. So don't have full rights to reside in the UK, unlimited, but they have certainly routes to buy or refinance back in the UK. And we even have lenders for, USA nationals, for Canadians, for, Chinese, etc., that want to buy in the UK. They can do that as well. So The key market for me is the UK market, and that's because it's got a very advanced financial marketplace. You know, there's many things that you can do with property, and financing routes are fairly easily accessed with the right broker partnership. But you mentioned about other areas, Spain, France, and Portugal. So yes, we have, we're a UK regulated, registered brokerage. We have links and introducer agreements with many lenders covering main areas such as Spain, Portugal, France, USA, and Australia. And we even have links to Gibraltar mortgages as well. There's not that many banks, but of course we can. Things to consider really sort of comes down to three things. Firstly, the person's income is going to be a key measure around how many options they're going to have on the table to be able to buy or refinance in the UK. The second thing to consider is experience. Is this a first-time buyer? Have they ever bought property before? Can they demonstrate experience as perhaps a landlord or having rented property out? So that's another key area, experience. And the third thing is, have they ever purchased or owned in the UK before? So this would be around the footprint of the individual. Do they have bank accounts? Do they have a credit file in the UK? Because that can open many more doors than if they didn't. Having said that, there are still options even for those that have no experience and no footprint. Now, they still probably need to have provable income. A recent case we had was an Israeli professional living in Israel around Tel Aviv, and he wanted to buy 3 investment properties in the UK. He had never purchased in the UK before. He didn't even have a UK bank account, but he could demonstrate a level of experience in investments, and we were able to source various lending facilities for him. So that demonstrates the sort of thing that we can do. Just touching on Gibraltar mortgages, of course, we've got some availability around that. But I wanted to ask you, while we're on the subject, briefly.
Can I just ask you something, interject and ask you something?
Sure.
I'm going to go a bit off script. I presume that you can also handle UK mortgages for UK nationals, or is that completely off the agenda?
Yeah, absolutely. So it's not only the UK expat that's residing abroad, but also the foreign national that's abroad. But if someone's living in the UK and perhaps they do a lot of travel, perhaps they're on a tier 1 or 2 visa, or they're a standard UK national and they want to become an expat, then of course we've got access to the whole of the market in the UK, the mortgage market.
So, but can you do for UK nationals in the UK, raise mortgages? You can.
Yeah, we're whole of market.
That includes bridging loans and remortgages?
Yes.
That's very good. Thank you, Simon. Yeah. I had a particular interest in that subject, hence the question.
Okay.
Thank you for that.
Problem. So yeah, as I was saying, Gibraltar mortgages are a little bit more tricky. There's not that many banks on the table, but we do have routes to market for those that want to direct the residency to Gibraltar. Now, Gibraltar's been in the news recently, Paul, with regards to its double taxation agreement. Could you explain a little bit more about that?
Yes, Gibraltar signed a international agreement, double taxation, call it what you want, with Spain in March 19, which requires ratification or may have just been ratified by the actors involved, right? Which is GIB, Spain, UK, and it really is a post-Brexit treaty that comes into effect with everything else that we're going to discuss a bit later. In my view, that agreement is more a statement of political goodwill in the field of taxation than an internationally recognized DTA agreement in standard OECD model form, which, you could sign, France could sign a DTA agreement with the UK, and the paragraphs and the wording and the clauses are pretty much the same, and you just make a few tweaks and change which are the signatory countries. But this one is completely off-field and diverts from the standard model because, as I said, it's more a political agreement than it is a standard OECD taxation agreement. And I think, again, personal opinion, I think it's designed to sweeten the relationship post-Brexit to guarantee that cross-border fluidity that is so important to Gibraltar, was so important after 1st of January. What it does, however, it makes it extremely hard for anyone to try and pretend to be tax resident in Gibraltar while still living in Spain. I think what you'll find is, I think Spain recently has doubled the number of tax inspectors and is really homing in on Brits, not necessarily the ones that purport to be in Gib but live in Spain. I mean, that's just one little segment. But those who pretend to be tax resident in the UK but are still living in Spain. But that covers clearly the ones that are tax resident in Gibraltar but actually living in Spain. I think the rules surrounding Spanish tax residency have been tightened considerably and have been clarified beyond any doubt. So if you're a Spanish national moving to Gibraltar, according to this treaty, you will always be deemed tax resident in Spain. If you take Andorra as an example, between, nestled between France and Spain, and they signed an agreement with Spain, if you leave, you exit Spain and become tax resident in Andorra, you don't have the same issues. You become tax resident in Andorra and you have no ongoing tax liabilities in Spain. Unfortunately, this tax agreement with all the political connotations would never allow a Spanish national to ever sever their tax residence in Spain, regardless of whether they actually move the main residence to Gibraltar. So that's a bit of a strange one. Non-Spanish nationals who have been tax resident in Gibraltar in Spain for over a year are similarly caught up by this new agreement, and they would continue to be treated as tax resident in Spain for a further 4 years after having left Spain and resettled in Gibraltar. So you can imagine it's quite a draconian agreement in that sense. And then it extends to other things, Simon, like, the administrative cooperation, and it extends to all kinds of matters. It's not just exchange of information, whether automatic, spontaneous, upon request, but it involves joint controls and participations in tax examinations abroad. So extremely close cooperation between Spain and Gibraltar in the area of taxation. It even includes, Spanish residents and nationals owning yachts and light aircrafts and so on. That would be reported under common reporting standard and this tax agreement as well.
Interesting. So what about a post-Brexit treaty with the EU?
Well, I think it's been drafted as we speak. To put it in simple words, I think it grants Spanish and EU workers the right to continue to seek employment in Gibraltar, and the quid pro quo is that Gibraltar joins, or supposedly will join, the Schengen area, which has the visa-free travel, and potentially, although still under discussion, whether Gibraltar will join, will be part for VAT purposes as well, for services. So that remains. But I think it's really exciting news on a couple of fronts. I think, firstly, we will enjoy greater. I mean, it's kind of ironic that having been associate members of the EU since 1973, on the back of the UK joining the common market as it was then, and then the European Union, that we never really enjoyed border fluidity in the true sense of the word, right? So that should, in theory, change considerably. I think what we're going to see, should Gibraltar sign, should all parties agree to this treaty, is that we join Schengen, but the physical land borders we know it will be demolished. It won't be demolished like the Berlin Wall, right, in 1989 or 1990. It's metaphorically speaking, but we will see an end to that land border. And I think for those within the Schengen area, whether it's people residing in Gibraltar and tax resident, they will have, they won't. I'll give you a practical example. A British national comes to Gibraltar and establishes their tax resident in Gibraltar, then they will cross that border within Schengen, right? There will be very light touch controls or no controls. A British national who flies from Heathrow, lands in Gib with the intention of crossing the border to Spain, they will have to queue up as a third country. So those are the obvious benefits. So I think they're doing away with the physical border or the, a lighter touch border, joining Schengen and all that. I think it's going to open up the the Gibraltar market considerably. And I think potentially that could be a stimulus for growth once we are post-pandemic. I think we'll have the visa-free travel within Europe, which is great. I think it will make Gibraltar more attractive as a business center, Simon, if I'm very honest. And I'm very hopeful that that's the case.
Yeah, very good. Interesting.
Simon, quick question for you. Because I get this question asked time and time again from our British and from our expat client base. If you're over 60, how easy is it to get a UK mortgage?
Yeah, it's a really good question. It's one of our commonly asked ones as well. I think it's good at the outset just to differentiate the two different types of mortgages that there are in the UK. Firstly, there is what's called a regulated mortgage. And what that means is it's really a mortgage that's used for your own use or for your family's use to live in. Now, on a regulated mortgage, the income of the applicant is assessed. And so when you think about this logically, usually a person's income will drop at retirement age. And so the only way to be able to take a mortgage beyond retirement age, which most lenders deem, if they don't voluntarily say 65, most lenders deem 70 to be the maximum that they'll permit you. So in theory, if you're age 60, you could get a 9 or 10-year mortgage based on the income you're earning at 60. But if you're wanting to take it beyond 70 to 75 or 80, then you're going to have to demonstrate what your income is going to be after age 70. Now, if the mortgage is still affordable, then yes, absolutely, they can take a mortgage to age 80. So that's on the first type of mortgage, which is a residential mortgage, which comes under regulated licensing. The second type of mortgage is a buy-to-let mortgage or unregulated. And this covers other things like semi-commercial, like bridging. This is when the property is not for your own use. It's being rented out or it's being developed for profit or for business use. Now on this, many people take this type of mortgage within a limited company structure, or they can have it on their own personal name. And it's interesting, on the unregulated type of mortgage, the buy-to-let mortgage, age is not an issue. So I've got clients in their 70s, some even in their 80s. I've got mortgages which will take them into their 90s or even longer. So the regulation falls away because the assessment of the mortgage isn't around the person's income and affordability, but what that property is going to generate as an income. So back to the original question, can expats 60 and over get a mortgage? In many, many cases, yes, but it will also depend on whether it's for a person's own use or whether it's for a rental use.
Simon, do they take if they feel that they haven't got enough security, are they able to take a charge over some other asset in addition to the property? If they're over 60 and the bank thinks that there's a credit risk in extending a mortgage, can you give, some assurances to the bank that it's going to be repayable by having a charge on another asset. Is that?
So I work with some lenders that can cross-collateralize. So they can use other properties or even some assets. But that sort of area that we would get into is more the private client area, where that they're high net worth and they want to use other assets and other things to sort of back or secure the loan. But yes, it's absolutely, definitely able to be done. But the standard unregulated mortgage tends to focus on the property at hand, or indeed the portfolio at hand, and lend as a percentage against that. And typical lend percentages are around sort of 75% maximum on unregulated mortgages. Okay. But many people who are retiring, of course, we know that the Costa del Sol and so on is a key area for many Brits to retire to, and they may still hold and have UK property. So those are many of the types of clients that I'm able to help. But of course, Gibraltar is becoming an area where many Brits are considering retiring to or relocating to. So why is that, Paul?
Well, I think predominantly there's 3 reasons for that. One of the reasons is, the better quality of life and the safe environment. I think that is one of the driving forces. Secondly, and I think even more importantly, I think it's a British territory where the certainty of English law applies. So if it's a family coming across and they're entrepreneurial with businesses, they can re-domicile. It gives them reassurance that they're dealing in English law, in the same language, and where the British pound still reigns supreme. Because, Brits are quite proud that they have, and quite rightly so, they've retained the British pound, and coming to Gibraltar is being, leaving the British Isles, leaving Blighty and the British shores for the Mediterranean, but still with English law and, same language and the same currency applying. So that is, I think, a great draw for Gibraltar. And then thirdly, it's a very stable economy, Simon, as you know, with a benign tax environment, which provides incredible opportunities for tax planning. And that is, again, another attraction of re-domiciling or relocating to Gibraltar.
Interesting. Now, is it true you don't have to live in Gibraltar any length of time to qualify for residency?
I'm actually glad you asked that question, because for me, it's an irritant. And it really annoys me when I have a lot of, interested parties flying across, staying at the Sanborn, coming to see me, and then they shop around and they're told, that you can become tax resident in Gibraltar, but not spend one single day. And I think that is, frankly, that advice is negligent advice, and it's a common pitfall. Yes, in theory, if you look at the legislation and you look at the conditions, it says that you don't have to spend any time in Gibraltar to qualify for Cat2 residency. But let's not confuse the rules for Cat2 residency with tax residency in different countries, because different rules apply. And even if you look at, establishing residency in Gibraltar further, in the small print, it says you need to spend a minimum of 100 days in 3 consecutive, I think it's tax years, or 300 days in 3 years to be deemed ordinary resident, right? Now, ordinary resident still doesn't shield you and protect you from triggering tax residency in a third country. Let's not try and, to sell property. Let's be clear, to sell property and to get people in, confuse the client and try and tell them that they can live here and get a tax register certificate. And that part of it is completely true. And that's it, you're done. Then you can go back to the south of France, in your house in the south of France in the UK, and you'll never be considered tax resident there, because that is not correct. I mean, the rules in Spain are very clear. It's based on two things: number of days, 183 days or more, and you trigger residency, or your center of economic and vital interest. Example: if you become tax resident in Gibraltar, but your wife is living in Soto Grande and your children are going to the public school in Soto Grande, then your center of economic and vital interest are in Spain, not Gibraltar. And if you look at the double taxation agreement between Gib and Spain, it is even more prescriptive in terms of where your assets are and what will trigger Spanish tax residency. So let's not, confuse clients as they apply for residency, because I think it's going to give the jurisdiction a bad name. Yes, we want to get the business, but let's be frank with the client and tell them what they can and cannot do. And if you look at UK nationals, because very often they're mainly Brits and they come over, but they still want to go back to the UK because they've got grandchildren or whatever, they are subject to the UK Statutory Residency Test 2013. And that is based on the number of ties to the UK. And depending on how many ties you have, that determines how many days you can trip over. So you have to be wary of that. So potentially, and in answer to your question, you could be triggering residency in Spain and in the UK and have a tax residency in Gibraltar. So one has to be careful. One has to tread really carefully, and they have to seek the advice of professionals, as making a mistake can be extremely, extremely costly. And, by all means, go to estate agents for property, but go to professionals when it comes to the tax advice, because, that's the whole point of coming here, to make sure that it, belts and braces and everything is done properly. Gibraltar doesn't promote brass plate addresses anymore. And even if it does, it doesn't work. So I think we have to move away from that and try and bring people who are legitimately looking to establish tax residence in locally.
Yeah, it's very, very, very wise advice there. So thinking about real life examples, Paul, have you got a case study or an example that you could give of someone who's a Brit or expat relocating to Gibraltar and how they would benefit?
Yeah, that's a really good question, Simon. And yes, of course, in answer to your question, I can. I'll give you one example. So let's say that we're dealing with a British national. He's an entrepreneur of retirement age, but still owning a few businesses in the UK. So potentially one of the things he could do, or she could do, would be to redomicile the company or companies to Gibraltar and reduce the corporate tax rate from, I was going to say from 19 to 10%, but given the budget, I now have to say from 25% to 10. So that's quite a saving, right? Of 15% reduction in corporate tax rate. I mean, something which is less important and trivial, but I'll mention it in passing, is that they can lower the, if they have a complement of staff employed, they could potentially lower the employer social insurance contributions that they pay on behalf of staff in the UK, because Gibraltar's social insurance contributions are very low in comparison to the UK. Assuming that he draws some income, I think there would be considerable savings there too, because the highest marginal rate of tax is 28. And as you may or may not know, Gibraltar has one of those innovative taxation systems. I would argue that one of the most innovative in the world, because all taxation systems globally are progressive. The more you earn, the more you pay. Gibraltar has a regressive system, and it's almost like a bell curve that, your marginal rate of tax goes up to 28 and then starts coming down and dropping down. So I'll give you an example. Once your marginal rate exceeds once your income exceeds £500,000, then your marginal rate starts dropping from 28. So to give you just one example, you would then be taxed at, so I'll give you a specific example. Let's say you earn, you're an ultra high net worth individual earning 1 million in income per annum. Because, it peaks at 500,000 of income and then comes down progressively. And if you earn more than 700,000, you only pay 5% on the excess. For someone earning over £1 million and drawing that income locally, right? The tax that they would pay on £1 million would be 17.6% tax. Now, if that individual is drawing even more than that, let's say it's drawing 1.5, then that marginal rate of tax would be even lower, because remember, anything in excess of 700,000 is taxed at 5. So your average starts coming down progressively. So that could be extremely, I think, interesting for someone earning a lot of money. Other advantages to Gibraltar residency that people miss out, particularly the case study that we're talking about, you know, the entrepreneur, they come to Gibraltar. This is not a condition for Gibraltar residency, but they could sell their business. They could sell their business and establish residency in Gibraltar. Sorry, establish tax residency in Gibraltar and sell their business, or equally establish tax residency in Gibraltar, redomicile the company, and years later sell on their business. Well, if they did that, they wouldn't suffer any Gibraltar capital gains tax, because there's no capital gains in Gibraltar, so that's brilliant. But, you know, potentially they could avoid paying any UK CGT tax on the disposal of their UK business, on the condition that they remain outside the UK for tax purposes for 5 complete tax years following the sale. So you've got a business that is worth, and I've had about 5 or 6 inquiries recently, businesses ranging between 10 million and 30 million, and they're planning to sell at some point. So they redomicile to Gibraltar, they get the business, they keep growing it, and then they say, okay, I'm going to flog the business now. It's valued at 30 million. Thank you very much. They sell it and they continue being tax resident locally for 5 more years, and then they will have paid 0 tax on that disposal. Well, if the business is worth 30 million and CGT in the UK, I don't know what it is, Simon. Is it 20? Is it, God knows what it is, but it's quite a lot, right? You can imagine how much they're going to save. So those are the less obvious things that residency. And then, of course, you have, you know, if you don't draw any income from your business, which you've just redomiciled, and you live off your investments and savings, you would have no tax liability, and there would be no CGT, and there's no interest, no tax on interest savings, and nor is there any tax on dividends from a recognized stock exchange. So you can imagine, again, that's another attraction. Then lastly, and point 6, if I may add before closing, is that even though there's no inheritance tax in Gibraltar per se, you do pay, the unsuspecting Brit is still liable to UK IHT, as this is based on the concept of domicile rather than the concept of residency. And domicile is not something you can shed easily. So you remain, you know, subject to UK inheritance tax, but being an expat in Gibraltar does provide tax planning opportunities and the ability potentially to mitigate, or, and again, this is case dependent, based on the value of the UK estate, but they could even eradicate that potential UK inheritance tax liability completely. So look, I've given you 6 examples of areas where becoming tax resident can save a lot of taxes, not just your typical retiree. You've got the entrepreneur that could benefit even more than your retiree.
It's very interesting, financial food for thought, Paul.
Yeah, and we have a Gibraltar residency video, which is more about lifestyle than tax. But again, I think my colleague Alice, who's moderating this chat, will share this afterwards with the attendees.
Sure.
Simon, I think I've spoken for too long. I need a break, so I need to fire some questions because you're having it too easy. I think it's slightly unfair on me. You know, I'm older than you and I tire easily, and you are firing all these questions from every conceivable direction, and I'm here hopeless and just having to answer. So I have a few questions for you, if I may.
Sure.
The first one is, should an expat set up a limited company to purchase a property in the UK?
Very good question. Very, very good question. There are a couple of things to consider really with this. Firstly, how many properties does the person currently own? Because if it's zero, then they should try and take advantage of any potential stamp duty breaks that they would already get in a personal name. And the second thing to think about is, what is their plan? They want to just buy one, they want to buy two, or do they want the portfolio of 10, 20, 30 properties? Because if that's the case and they want to build a portfolio, then looking at a limited company structure may be very advantageous. The government in the UK have phased out being able to offset interest on finance over the last couple of years as a tax deductible, but limited companies can still offset those finance costs. So there's quite a good mechanism there to reduce tax liability. Another thing to consider is if someone's building, multi-property portfolios and then they were to pass away and it was held in personal name, then they could be facing a very big, capital gains tax plus inheritance tax issues. So succession tax planning could be advantageous to have properties held in a limited company name. In fact, I had a recent client, he had around 40 properties in his personal name. We ran the figures and it was very advantageous to put those properties into a limited company. So worth considering. I think the key thing is every case is different and it will depend on the person's circumstances and what their goals and their plans are for property holding in the UK. So one of the things that we can do is set up a discovery call, a free call with a tax agent. And if they're also a Gibraltar resident or a person that's considering that, then we get on a group call with yourself, Paul, and the tax people, and we run the numbers and make sure that the advice they're getting is the best. And at the end of the day, it's an efficient plan and route into the UK market, and also thinking about the exit route as well, passing on wealth. So it really does depend. So there's no yes or no answer on that one, but I hope that gives some structure and guidelines as to what we would look at for expat lending in limited company structures.
No, that's very good. That's a very good explanation, Simon. Thank you. And I have a follow-up question to that. If the expat has an offshore company, can it also purchase UK property?
Yeah, the quick answer is yes. What I would say on this point is when there is an offshore SPV, many of the UK banks, and I'm talking sort of your high street normals, are going to disappear off the market. They're not going to be able to offer that. But we work with specialist lenders. Some of them are offshore lenders. Some of them are private bank offshore lenders, and they will consider offshore SPVs in a number of regions like BVI, Gibraltar, Malta, various regions where offshore SPV property holding companies want to refinance or buy UK property. We can do that.
Simon, are they repayment mortgages or are they interest only? And what is typically the loan to value?
Yeah, good question. So again, there is flexibility on whether the loan is structured on a repayment basis or on an interest only basis. Interest only is usually not a problem when it comes under that second category of property, which is buy to let or for rent use. Interest only, you can usually have all day, every day, up to sort of 75% loan to value. When the property is for your own use and maybe it's held in a limited company, then usually capital repayment is a requirement. But again, there's some flex, especially if the lender is a private lender and we're dealing with high-end property, 2 million plus value, then you can look at, interest-only options up to around sort of 60, maybe even 70%.
And Simon, talking about case studies, can you give us a typical case study and how that would work?
Yeah, well, I'm aware of time. I'm going to give you two quick ones.
Yeah.
Typical examples of clients that we help in the expat offshore market. So I've got an expat in Dubai, current client. He had 3 or 4 properties in the UK in his personal name, on reasonable income. But what he wanted to do is to start buying more property in preparation for his retirement. And he wanted to set up a limited company in the UK to hold these properties that he was going to plan to buy over the space of the last 6 months. He's actually on his 7th property now. So what we were able to do is put a lender in place to take all of those 7 properties that were going to be held in a limited company structure. Now, the interesting thing is when we work with portfolio lenders, when they approve the first mortgage, we can usually fast track the next because it's already been underwritten. So in the space of the last 4 months, he's had accepted and agreed on 7 properties, and he's very pleased that the stamp duty deadline's been extended to June. So that's going to help as well. But yes, that's a typical client, a portfolio landlord that we can help, even though they're an expat and they're living in the Middle East. And another type or scenario case study that we often get is expats, perhaps a doctor living in Hong Kong. This is a common one that we see, where they have a young family, perhaps a couple of children who are coming up to a critical age for their schooling. And many of these expats, they want to send their wife or their husband and kids back to the UK so that those children can re-enter into a school of their choice that they want their kids to go to. So in this instance, this is an expat mortgage, but for family use, for their own use. And we were able to help a client recently to do that, to get a mortgage for 500,000, 75% loan to value. The rate was fabulous, 1.29, 2 years fixed, so that the wife and the children could return to the UK while the expat remained in place in Hong Kong, earning there. So we're using a foreign currency mortgage. We're providing an expat mortgage for family use, for family to return to in the UK. So that's another typical case study that we help with and have helped over the last sort of 2 years, many clients to do that.
That's brilliant, Simon. Should we proceed to Q&A? Is that an idea?
Absolutely.
If there's anyone that wants to put a question to the panel, now's your chance. Oops. Any questions? Sorry, I can't see them.
You've done such a good job of explaining it, Paul.
No, there's no questions. I'm not even sure how I can see them. No, Alice, can you handle that? No. No questions.
No questions.
There's no questions from. Yeah, we must have either we've done a great job or they've all fallen asleep. Yeah, everyone's fallen asleep. So I don't know what it is.
One of the two, yeah.
Yeah. So Simon, again, delighted that you've been able to join us today. Okay. There's a question. You can see that. No, Simon, I think that's for you.
Yes, it is. It is. Second properties. So you're quite right. The second property stamp duty, there is a second property stamp duty rate, but they still benefit from there is an amount they will benefit from even on a second property purchase. So the rate will be lower, but it's not as good as if they're buying their first property. I hope that explains it. We can post the stamp duty calculator links, which will explain that. But yeah, you're quite right. there is a second property stamp duty, but they still benefit from a slight discount.
Thank you, Simon. Okay. Thank you, Nicholas. I think
just
that
actually
answers.
on stamp duty as well, there is a non-resident stamp duty coming in on the 1st of April. That isn't going away. So there is that that extra stamp duty rate that's coming in.
Okay. Simon, I think it's been a pleasure to have you on this webinar, and I hope this is one of many to come. You've given fantastic explanations about expat mortgages. I know I've gone off script a few times because it was really quite interesting, and areas where we do get inquiries, and hopefully we can arrange one in the not too distant future. So thank you very much, Simon, for joining us, and thank you for everyone who's tuned in today. I hope we've given some value, and yeah, if you have any inquiries, please give us a call, because we always either Simon on the expat mortgages, or on my side, wealth management advice and residency relocation. I think you're in safe hands with good professionals. So again, thank you for
Paul,
listening.
for having me along. Really appreciate it. And as we are working together with clients, it's certainly a pleasure to be along today.
Thank you, Simon. Thank you, everyone.
Thanks all for joining.
Have a great day. You'll get links, to the videos soon. Thank you very much. Bye-bye.
Bye.